white collar job creation has come to a standstill, which means consumption, which is 60% of GDP, has got jammed, which means earnings growth has gone up. So ironically, right, the opportunities are in American and European small and mid caps. In spite of Trump's chikna chillana, the global economy remains integrated. Between the last time you interviewed me in this room to now, most people watching wouldn't have earned anything in Indian equities. But those who've continued having a 50-50 portfolio, उनका American portfolio खूब चला होगा. उसके बाद the second logical diversifier is gold, right? Gold and Indian markets का correlation positive है but reasonably low है. So the bulletproof portfolio will be India 1/3, Nifty 50, America 1/3, small and mid के आसपास, S&P mid cap is a good index to lock into, and gold final one. Indian equities large cap is the dal roti. American equities is the sabji, and small and mid cap in India was supposed to be the achar, but because the achar is tangy, some people in India seem to have made small and mid cap the main part of the meal. Sorry, they've made the achar. It will take India 2-3 years to transition. In that transition, earnings growth subdued rahega and returns from the stock market will be correspondingly muted. And unless we see relief on this, unless by November end an FTA is struck, I think there will be job losses here, which will have an impact on dragging down consumption. REITs has done very well for us. I think last 12 months it's doubled on us, Deepthi. And it's a company which has around 25 to 30% of its revenues from exports to the United States. So that means hospitals, diagnostics, medical devices, Diwali, this whole industry will continue to do well, and we continue to find good ideas in that space. The second industry which will be long-standing investors, लेकिन यहाँ पे एक पूरा नया dimension आ रहा है, is the three best banks in the country.
As Samvat 2082 begins, Indian equities are facing a mix of optimism and overvaluation. So will the rally broaden out, or will investors have to look ahead and take the path with caution? So we have Saurabh Mukherjea with us, who will help us decode markets. He's someone who strongly believes on holding on to high quality businesses and let compounding do the work. He's the CIO and founder of Marcellus Investment Managers, and let's talk to him about his playbook for the year ahead. Hi, Saurabh.
Hi, thank you for inviting me, Deepthi, on a very delicate set of questions. Go on.
Thank you for coming here, and thank you for making time for us and giving your take. So let's begin with the first question. The thing is, like we saw in the past year, we've seen a whirlwind of geopolitical stress and quite ups and downs, and when we looked at Nifty, it's not moved quite as much. So investors are cautious considering all that. The negative had gone down to the returns had gone down to negative. So what are the biggest risks and opportunities you're looking at for Indian equities in the coming year?
So look, the biggest challenge for the country is that earnings growth, right, profit growth has slowed to a crawl in the last 5 or 6 quarters. So effectively over the last 2 years, for the last 8 quarters, earnings growth has taken a nosedive in India. And behind that, the core driver behind that is white collar job. White collar job creation has come to a standstill. In fact, my reckoning is now because of the IT job losses, white collar jobs are shrinking in India. There's roughly 40 million people like us who do white collar jobs like us, and people like us end up employing another 200 million people, right? The people who cook for us or drive our cars or serve us meals in restaurants and so on. These 240 million people, 40 million of us, 200 million people who work for us, these 240 million people basically are the core of India's consumption engine. And यहाँ पे job creation रुक गया है, which means consumption, which is 60% of GDP, has got jammed, which means earnings growth has gone up. And if earnings don't grow, it's very difficult for a market where, as it is, multiples are so high in India, as it is, the Indian market is trading at lifetime high multiples, very difficult to move the stock market forward. That's the core of the challenge. The government is awake and alive to it. They've given a massive consumption stimulus over the last 6 months, the income tax cut, the GST cut, the rate cuts from the RBI, the ban on real money gambling and so on. It will take time for the consumption stimulus to kick in. I think over the next 3-4 quarters, the consumption stimulus will kick in. But even then we'll have the big underlying problem कि white collar jobs कहाँ से आएंगे, because AI and automation means that employers like your and mine and most other large companies in the country need fewer and fewer people to do the work that's required to be done. The same is true the world over, but in countries like America or Europe इतना labor supply नहीं है. India में labor supply heavy है, and AI and automation is putting paid to job creation. This is the core of the challenge India faces, and valuations are rich, which is why the market is refusing to move forward.
How do you look at the geopolitical macroeconomic situation?
So ironically, right, the opportunities are in American and European small and mid caps, because American and European small and mid caps ka earnings growth over the last 1 year, 5 year, 10 year, 20 year, earnings growth for American and European small and mid cap has been twice that of India, 2x. So India ka earnings growth करीबन 5.5-6% है dollars में over long periods of time, and American mid cap earnings growth is 11-12%, right? So not only is earnings growth double, but valuations for Indian small and mid caps are 30, 40, 50 times. American small and mid cap valuations are 15, 20, 25, right? So valuations are half of India. P multiples के तौर पे देखें, valuations are half of India, earnings growth is double that of India. And I think that piece is looking very interesting, obviously because of Trump and all the drama that he creates every week. Even investors in the West are scared of Western small and mid caps, but I see an opportunity there, that because Western investors are so scared of Western small and mid caps, it allows people like us sitting in India to diversify away from India, where, as I said, valuations are punchy, growth is mediocre. So diversify away from India into small and mid caps. And in all credit to GIFT City and the government of India, right? Through GIFT City, we've been able to access Western equities at low cost with a very efficient taxation regime. So taxation of Western equities is no worse than India now, and GIFT City is a very cost efficient infrastructure. So because of GIFT City, the world has now opened up, and I would strongly urge everybody who's watching, diversify out of India into Western equities, specifically Western small and mid caps, because that's the only way you will be able to flourish in a globally integrated economy. In spite of Trump's chikna chillana, the global economy remains integrated. We are in a very tough spot in the global economy, where our economy has got jammed with very high valuations. Western world mein small and mid caps earnings growth remains punchy, and valuations are half of that of India. There's a compelling case for diversification.
Is that the positioning that, that's the positioning that you took for Marcellus, like diversifying into the Western?
Yes, so 3.5 years ago, we built that Western equities ka team. We built it out of GIFT City. We went to New York, hired talent, came back to India, hired more talent, and then the team got based out of GIFT City. And then 3 years ago, the portfolio kicked off. And over the last couple of years, almost all of us in Marcellus have put half our money in Western equities. And those clients who come to us, we also urge them to do the same, because over long periods of time, if you take 10 years, 20 years, 30 years, India and America are the best performing markets. Both India and America over long periods of time tend to deliver around 10% dollar returns. 10% dollar returns ka CAGR hai, both India and America. But the beautiful thing is that these two markets have very low correlation. इनका एक दूसरे के साथ ज़्यादा रिश्ता नाता नहीं है, right? As a result, if you're able to put half your money in either of these markets, 50-50 Indo-American portfolio, your returns do not get compromised. Both markets fundamentally return 10-11%. These are the only two large markets in the world, by the way, Deepti. These are the only two large markets जहाँ पे आपको double-digit dollar compounding मिलता है. But the beautiful thing is, because the correlation is low, if you put both of them in your portfolio becomes far more resilient, far more robust. So the sort of plight that many people in India have suffered, last 12 महीने में कुछ कमाया नहीं है. Between the last time you interviewed me in this room to now, most people watching wouldn't have earned anything in Indian equities. But those who've continued having a 50-50 portfolio, उनका American portfolio खूब चला होगा. Both American large caps and small caps have done well, and therefore the merits of diversification become evident at these junctures. There'll be other years in which America won't deliver, but India will deliver. So having a single country equity portfolio, whether it's a single country America or single country India, I don't think is a very clever idea. In a globally integrated economy, having a diversified global portfolio makes a lot of sense, and specifically diversify amongst the two strongest markets in the world, the United States and India.
So, Saurabh, that has actually opened a can of questions. So, firstly, India has been the worst performing market if we look at in the past Samvat year. It's basically given around 3% returns as compared to the other European and American markets also. So, how do you interpret that, considering you're saying that India and America is
So look,
good?
firstly, two parts to it. If you step back and think about it, right, every large free market economy will go through ups and downs, right? कोई भी free market economy, not India, not America, goes up in a straight line. Just simply doesn't happen. Economic cycles in every free market economy, economic cycles are a fact of life, right? So India had 3 good years after COVID. 21, 22, 23 were good years. Somewhere towards the end of 23, the Indian economy started sagging, and it still hasn't recovered. As I said, it's not an easy downturn to pull out of, because the core job creation engine is properly jammed. But we will pull out of it at some stage. शायद और 1-1.5 साल लगेगा. Another 4 to 6 quarters out, I think the Indian economy will come out of this, right? Now, from the perspective of those who are watching, right, if you stay invested in one economy, you're condemning yourself to this roller coaster, right? Every economy will go through ups and downs. तो अगर आप एक ही economy में पैसा डालोगे, तो your whole life you'll keep going up and down. And if you're like most investors, you will be putting money in the market at the worst possible time. आप बिल्कुल ऊपर में पैसा डालोगे, फिर the economy will turn down, you will suffer, you'll get depressed, you might even redeem money at the bottom, right? So what is the panacea? What is the remedy? Right? इसका remedy है diversify across free market economies, diversify across strong, healthy free market economies who have different cycles. So American economy has a cycle, Indian economy has a cycle, but the cycles move at different speeds, right? So over the last 12 months, as the Indian economy has got jammed, the American economy actually is quite healthy, right? They have been steaming along in terms of credit dispersal, job growth, bond market yields. I think bond yields are in the lowest juncture ever. Stock market is hitting all-time highs. The tech ecosystem is the most dominant in the world. India is going through a tough 12 months. So over the last 12 months, those who have been 100% invested in India, उनका कोई पैसा नहीं बना होगा by and large. And those who have been diversified across India and America would have seen a healthy outcome in the portfolio. Similarly, if somebody, for American investor sitting in, say, Los Angeles, if he simply does American equities, he'll go through several years of no returns. For example, from 1967 to 1984, American equities gave us 0% return, right? So those poor American souls who was just invested in American equities from 67 to 84, उनका कोई पैसा नहीं बना. So for investors in both countries, America and India, it makes a great deal of sense to do 50-50. I say this to Americans when I go to America, and I'm saying this to Indians now that I'm sitting in my ऑफिस इन मुंबई. आधा आधा कर लीजिए. जिंदगी में कमाई ज़्यादा होगी और आपको रात को चैन की नींद आएगी. You won't have to go from one Samvat to another with zero returns.
To avoid volatility basically in return.
To avoid stress, to avoid tension कि मेरे पोर्टफोलियो से पैसा क्यों नहीं बन रहा है. दिवाली का मज़ा दूसरा आता है. If going into Diwali, going into a Samvat, you made good returns. Those of us, those Marcellus clients who over the last 12 months have walked the global walk with us, which is India में पैसा लगाओ and America में पैसा लगाओ. Those Marcellus clients who have done that are having a happier Diwali than those other investors watching this who haven't done any global investing as yet.
What do you think about like other markets, one, and also what about gold and silver? They've run up like 50% or 50% in a year.
Yeah. So let's come to other markets, right? Other equity markets don't have the same degree of low correlation with India that America does. So for example, China and India, the markets are far more tightly correlated than the Indian market and the United States, right? Indian market and the United States have low correlation because the economic structures are very different. Theirs is a tech-driven economy. India is a labor-driven economy, consumption and low labor cost-driven economy. Theirs is a presidential democracy. Ours is a prime ministerial / parliamentary democracy. Their financial system is financial markets led, right? Both bond market and stock market. Our financial system is banking led. The bulk of capital dispersal in India actually doesn't happen in the stock market. The bulk of capital dispersal in India happens because of the banking system, right? We are a low income country. $500 पर कैपिटा इनकम है उनका हमारे से 20 गुना ज़्यादा है, राइट. सो दे फार रिचर कंट्री. सो बिकॉज इंडिया एंड अमेरिका सो अनलाइक ईच अदर, you get diversification. India and China are actually more similar to each other. China is richer than us, but 5x, not 20, 30, 40x. Right? So, दूसरा markets have less attraction for me than than North America.
What about Brazil, etc.?
No, you don't get diversification benefits because those are commodity-driven economies, and they move. The most emerging markets, India, Brazil, China, tend to move in sync. Ironically, this year India has been the worst performing emerging market, but over longer periods of time, Deepti, most emerging markets एक दूसरे के संग move करते हैं, whereas the United States is a distinct entity. Now, let's come to gold. Right, gold is very interesting in this regard. After United States, अगर आपको निफ्टी के बाद डाइवर्सिफाई करना है तो S&P 500 यूनाइटेड स्टेट्स इज द लॉजिकल डाइवर्सिफायर. उसके बाद द सेकंड लॉजिकल डाइवर्सिफायर is gold, right? Gold and Indian markets का correlation positive है but reasonably low है. The difference is, the reason I put it after the United States is the US stock market long term returns are 10-11% in dollar terms. Gold का long term dollar returns are around 6-7%. So gold and India have low correlation, but gold का returns थोड़ा कम है, but from a correlation perspective it makes sense, right? So a portfolio which is 1/3 India, 1/3 Nifty 50, 1/3 America S&P 500, and 1/3 gold will give you long-term dollar returns in the vicinity of 12-13%, which is a very good outcome. Rupee outcomes of 14-15%, right, with low volatility, right. Nifty can give you long-term returns of 12-13% in rupees, but uska volatility will be far more. So having gold as a diversifier also makes sense. But the difference is this, right? At this juncture, gold is pretty punchily priced, right? So the time to diversify into gold will be when gold gets beaten up, and I suspect that will happen when globally the risk appetite improves. Globally people are scared. They're scared because of everything Trump is doing, everything that Russia and China are doing. They're scared because of the prospects of conflict in the Middle East, right? So because investors are scared, they're loading up on gold. If you also load up at gold in this juncture, it's not a disaster, but the chances of getting effective diversification when gold has already run up are low. So I would suggest wait for gold to come off and then make it 1/3 of your portfolio. Now if you already have gold, and you have Indian equities, then I would say make Indian equities and gold 1/3 each of your portfolio, and the final 1/3 of your portfolio make it US small and mid cap. US small and mid cap is trading at a 26-year low. US small and mid cap is trading at a 26-year low in terms of its discount to the S&P 500. S&P 500 महंगा है. S&P 500 is just as expensive as the Nifty in terms of forward PE, albeit with far better earnings growth. But US small and mid cap is सस्ता, right? So diversify from India and gold. If you have India and gold already, इसको 1/3 कर दीजिए, and the final 1/3 of your portfolio उसको S&P small and mid cap कर दीजिए. There are plenty of ETFs which allow you to do S&P mid cap. If you only have Indian equities and you need to diversify, then the diversification trade today should be out of Indian equities 50% India, 50% US small and mid cap, right? Gold अभी मत कीजिए, wait कीजिए for a better juncture.
So are you also suggesting to probably reduce exposure to gold? Because
so if you already have gold and it's more than 1/3 of your portfolio, then bring it down. Yeah. So the bulletproof portfolio will be India 1/3, Nifty 50, America 1/3, small and mid के आसपास S&P mid cap is a good index to lock into, and gold final 1/3. There's plenty of gold ETFs in our country which you can use.
So how do you look at returns from here on? Like, do you tell investors to moderate their expectation, or do you probably tell them that there could be another round of exuberance, or just simply look at realistic compounding?
Yeah. So it depends on which market. If you were to say you're a global investor, you don't care about one market or the other, आप पूरी दुनिया में पैसा लगाते हो, I would say at the global level, the outlook is reasonable. Though global level, if you have a diversified global portfolio between India, the United States, and gold, you should still be able to get double-digit dollar returns over the next 3-4 years. If you have only an Indian portfolio, और आपको सिर्फ इंडिया करना है. रिमेंबर, सिर्फ इंडिया करना इज अ स्लाइटली अनयूजुअल थिंग बिकॉज India is only 3% of the global stock market का market cap, right? Why would you want a portfolio which is just 3% of the global market cap? After all, हर एक IPL team में केवल Indian players थोड़ी ना होते हैं. Every IPL team has, I think out of 11, 4 players are international players, right? तो अगर IPL team में भी 11 में से 4 खिलाड़ी विदेश से आते हैं, why should your portfolio only be drawn from 3% of the world's market cap? But if you're one of those people who said नहीं, मेरे को सिर्फ सारे दुनिया का केवल 3% में ही इन्वेस्ट करना है, इंडिया में ही डालना है, I think the next few years are going to be tough. Earnings growth, I think, is looking bleak. There is a rebalancing of the Indian job market which will have to happen. People like us will have to get accustomed to the fact that the standard white collar construct कि हम एक कंपनी ज्वाइन करेंगे, फिर वहाँ पे हमारा अप्रेजल होगा, प्रमोशन होगा, पे राइज होगा, वो चलता रहेगा, वो वाला चीज़ आई थिंक ख़त्म है वो स्टोरी. वी विल हैव टू ट्रांजिशन टू अ गिग वर्क इकोनॉमी एंड गिग वर्क इन इंडिया विल नो लॉन्गर जस्ट बी food delivery and ride share. Gig work will also be professionals like you and me working in a variety of gigs, and because of the way our digital economy is constructed, वो काफ़ी possible है, right? काफ़ी possible है. The rise of GST means all of us can work anywhere in India, sitting anywhere else in India. Broadband costs are the lowest in the world. Mobile broadband in India costs 1/40th of what it costs in America. UPI means that it's easy to get paid digitally. So the gig work economy is the future. The Purana economy is the standard white collar employment wala construct. It will take India 2-3 years to transition. In that transition, earnings growth subdued rahega and returns from the stock market will be correspondingly muted. But that shouldn't be a problem because the world is our oyster. As I said, through Gift City, the whole world can be accessed very cost efficiently, tax efficiently.
Do you think that this, trade negotiation / trade war with the US could probably slow down earnings growth or expectations?
So clearly, asar to padega. I do think India and America will end up with an FTA. It's not doesn't make any sense.
But at least till then, maybe.
हाँ जी, जब तक ये FTA आता नहीं है, these 50% tariffs that the US president has imposed on India will obviously hurt our blue collar workers. So I went to Tirupur a month ago. I could see the distress already building up a month ago. With each passing month, the distress will build up in the textile community. I went to Eastern UP 3 weeks ago. I could see the distress. The Eastern UP carpet belt exports to America. वो handmade carpets है. China machine made carpets बेचता है US में. इंडिया के लोग, ईस्टर्न यूपी के लोग हैंडमेड कारपेट्स बेचते हैं. अगेन बिकॉज ऑफ द 50% टैरिफ, the businesses are getting disrupted. The gems and jewelry industry in Surat similarly is getting disrupted. So between gems and jewelry, textiles, carpets and leather products, jute, sports goods, there'll be around 20 to 30 million workers whose livelihoods are at stake. And unless we see relief on this, unless by November end an FTA is struck, I think there'll be job losses here which will have an impact on dragging down consumption. As I said, the government has created a chunky consumption stimulus that should be kicking in over the next 3 to 6 months. But if Trump's 50% tariffs continue, a substantial part of the consumption stimulus will be offset by the brutality of the US president's 50% tariffs.
Are there any sectors or probably themes that you're finding fresh ideas in, or are you just probably adding on to like the winners you already have in your portfolio?
So look, one area which we've been investing in actively for last 7-8 years, and we've continued to find new ideas in that area is healthcare in the domestic context, right? So the government of India has made it pretty clear that whilst the government will sponsor the Ayushman Bharat scheme, underwrite the Ayushman Bharat scheme, the government itself is not minded to set up more hospitals, right? And with employers now providing employers providing Medicare, the government providing Ayushman Bharat, it does look like the whole of the country will end up getting treated by private sector hospitals, and depending on whether the patient is insured with Ayushman or with a private sector insurer, खर्चा वहाँ से आएगा, right? So that means hospitals, diagnostics, medical devices, dawai, this whole industry will continue to do well, and we continue to find good ideas in that space. The second industry, the second industry which will be long-standing investors, लेकिन यहाँ पे एक पूरा नया dimension आ रहा है, is the three best banks in the country. I think HDFC, ICICI and SBI. The banking industry seems likely to become a three-horse race, with the rest of the banks falling and fading away on both sides of the balance sheet. बाकी banks को deposits उठाने में भी दिक्कत हो रही है, they're struggling on the liability side, and as the white collar job losses mount, the rest of the banks will also suffer non-performing assets, because you say IT workers will default on their home loans and car loans. So the banking industry looks likely to get back to the sort of paradigm we saw a decade ago. Those are 13, 14, 15. In that era, it was HDFC, ICICI, and Axis. This time around, it's HDFC, ICICI, and SBI, right? And the rest of the banks, I think, will fade away. Now, this is a big deal because 30% of the index is financials, and effectively 30% of the index effectively becomes three stocks. These stocks, I think, will end up doing quite well in what will be a difficult period for the market. And the third piece is the consumption theme. Given that this the stimulus from the government, our estimate, Deepti, is the consumption stimulus is roughly $80 billion. That's around 1.7% of GDP, and that kicks in over the next 3-4 quarters, and therefore consumption, whether it is FMCG, whether it is auto, whether it is consumer durables, should see a better couple of years compared to what we've seen in the last couple of years, which has been pretty dismal on the consumption side. The theme which suffers is government CAPEX, given that tax collections, both direct and indirect, are flagging, and given that the government will need to do more stimulus. I think there'll be further stimulus on consumption in the union budget. I think the government will pare back that 11 trillion rupees ka government CAPEX ka outlay. I think we'll be seeing a single-digit CAPEX outlay even in this year. The rest of the year, as the fiscal situation deteriorates, remember GST collections are running at 9%, right? Not the budgeted 11-12. And as the cut kicks in, the GST cuts that were announced on 22nd, or that kicked in on 22nd September, and GST revenue growth will also conk off. So fiscal recalibration hoga, and in that fiscal recalibration, I think government CAPEX gets throttled off. So the whole ecosystem in the Indian stock market around investing in either PSU names or these companies who are contractors to Indian Railways, the defense sector, road builders, यहाँ पे I think pressure आएगा stock prices.
So I was going to come to that. How would you look at these companies that get most of their revenues from these government entities, especially in case of some of the road contractors and defense companies?
Yeah. So look, I mean, whether a company has a government or private sector clientele, any company where the bulk of revenues come from one customer is always a tricky proposition to invest in, because वो customer कब switch off करके light बंद कर देगा आपको पता नहीं है. And therefore I've always been a little perplexed as to how other investors get so enthusiastic about investing in contractors who supply to the government, right? Many of these stocks are now trading at 50, 60, 70, 80, 90 times. They've tripled, quadrupled in the last 3-4 years. And as I said, if I look at the budgetary situation, given that tax cuts are going to have already come and there's more to come, I think there will be more tax cuts on the anvil in the next union budget. I think that 11 trillion rupees ka government CAPEX ka number will throttle off now. As it is, even if the government does say 10 trillion in this current fiscal, I think this will be the third fiscal consecutively of the number being around the 10 trillion mark. So therefore, if the government CAPEX number is not growing, difficult to see how the suppliers' revenues are gonna grow. There is a business to be built. There are businesses to be built around supplying the government. Just that the valuations they trade at in the Indian stock market don't seem to align with any underlying sense of reality.
I mean, talking about tariffs and you hold Carousel in your portfolio. So it has exposure to the US. Around 27% of the revenues come. So it falls in that tariff and consumer discretionary bucket. So what's your stance on that? How are you looking at that? Are you reducing exposure? Are you planning to kind of lap it up?
So look, I mean, Carex has done very well for us. I think last 12 months it's doubled on us, Deepti. And it's a company which has around 25 to 30% of its revenues from exports to the United States, right? And what they make, for those who don't know, they make quartz sinks. So there are aluminum sinks, which is the kind of sink I grew up in, the house I grew up in, but now increasingly our offices, our houses have these quartz sinks. The world leaders are German companies. There's a company called Schock, which is the world leader, but they tend to be expensive. Carousel makes high quality quartz sinks, but they're 30-40% cheaper than the German stuff. As a result, say global retailers like IKEA, an American retailer called Karan, they buy from Carousel. So we bought it 2 years ago. It's doubled on us in the last year. Given that 25-30% of its revenues come from America, and given that America seems intent on pounding India till they get their FTA, we've curtailed the position in Carousel. We really like what they do, but valuations are punchy, stock has run up. Domestic consumption will, I think, do pretty well over the next couple of years, but the American situation is worrisome, and hence we've tapered the position off over the last month or so.
Looking at the broader market, do you think are we like ahead of our fundamentals, or are
Indian market?
Yes.
Yes, I guess it always happens, right? What happened was people sat at home through 2020, 21. They started putting money in. Then then everybody got unlocked from home. The economy took off. They put more money in. And then 2 years ago, the economy started going south, but people were still in full josh, and they kept putting money in. So if you look at the flows, right, every year mutual fund investors are putting in $30 to $40 billion, regardless of the fundamentals. That was all right till say 6-7 months ago. But that was all right till 6-7 quarters ago. But over the last 8 quarters, the economy has gone one way, niche, and the flows have stayed punchy at 30-40 billion, and that's created an obvious disconnect between very demanding valuations and fragile fundamentals.
So there's also retail participation actually, which is at a record high. So does that bother you, like that phase of the market?
I mean, it sort of doesn't bother me because every country goes through these. Every country goes through these cycles where the retail investor gets very excited, keeps putting money in, and then they get caught out when the market corrects. Every country goes through it. It doesn't bother me at that level because kuch naya nahi ho raha hai. But it's distressing to see. It's distressing to see because you can see hardworking people who want to get decent returns in life, but they get enthusiastic about the stock market at the worst possible juncture, and therefore the correction catches them unawares. I saw the same thing in real estate in 2012, 13, 14, 15, right? The real estate boom started in India 2003, 2004. By 2011, 12, anybody who could anybody who had a heartbeat was taking mortgages to buy properties in the suburbs of Bombay, Delhi, Bangalore, Kolkata. And many of those people who bought properties in that era, the price of the property is still much the same, even though 10, 11 years have elapsed, right? And I think there's a distinct risk that those who have loaded up on small and mid caps, and remember 80% of the flows, AMFI data is showing, 80% of the flows over the last 4 years have been into small and mid cap mutual funds. So there's a risk that those who have loaded up on that get several years of single digit or perhaps zero returns. So it's a little bit like we're all supposed to have a diversified thali, right? In the diversified thali, you could argue Indian equities large cap is the dal roti, American equities is the sabji, and small and mid cap in India was supposed to be the achar. But because the achar is tangy, some people in India seem to have made small and mid cap the main part of the meal. They've made the achar the main part of the meal. So you can guess kya hoga, right? If achar is the main part of your meal, I think you'll suffer some consequences, some digestive consequences. If rather than dal roti, which is Indian large caps being the main part of your meal, if achar is the main part of your meal, because that's what you like, you like the tang and the sense of tingling in your tongue. If you do too much of it, it can be a bad thing. I think that's the risk I think we are in. It's not new. I've seen this happen before, but it is just distressing and sad to watch at the same time. So I hope we get a soft landing in that rather than a big small and mid cap crash.
Where are you placing REITs and InvITs in like the whole
So
allocation?
REITs and InvITs, I think there's good REITs and bad REITs. We've got a fair few in our portfolio which we think are good REITs, and the good REITs we reckon will end up giving us 7-8% returns if we are lucky, maybe 10% returns. And we have them in the portfolio as almost like a cash plus. Our small and mid cap portfolios have lots of cash in it because of our concerns on valuation. If we just had pure cash, normal liquid funds, केवल 6% मिलता. So we thought rather than just having cash and getting just 6%, why don't we have some REITs as well and try to get the number to say 7-8%. But I stress there are good, just like there are good stocks and bad stocks, there are good REITs and bad REITs. So those who are buying REITs and InvITs should do their work on the sponsor's integrity, the auditor, the quality of the asset, the quality of the governance. Because REIT से भी आप पैसा चोरी कर सकते हो. So just be careful about blindly investing in REITs. Check the accounts, check the governance, and if you're comfortable with that, then by all means invest in REITs and InvITs.
So coming towards the last segment of this interview, any toughest lessons that you probably learned recently, or any memorable hits and misses? So
right. So I think the big learning over the last 5-6 years has been, right, I'm preaching to you diversification, but वो सीखे हैं थोड़ा सा, lived and learn किए हैं. Before COVID, I used to do something very different. I used both for my personal money and for clients, we used to say, build highly concentrated portfolios of a few stocks and sit on that. We still have highly concentrated portfolios in Marcellus, but what we now do for ourselves and we tell our clients is have multiple such highly concentrated portfolios with very different risk reward characteristics. So we still have consistent compounders. It remains a highly concentrated primarily large cap portfolio, but we also have a Western Hemisphere, the global compounders portfolio, which is also concentrated, but in a different part of the world, right? If I just had my entire life savings in any one of these highly concentrated portfolios, then it would be a recipe for sleepless nights. And I've had plenty of those till 2022, and it's in 21, when the second year of COVID, that this realization dawned on me that I can have, or Deepti can have, highly concentrated portfolios, but she needs multiple highly concentrated portfolios with very different risk reward characteristics, so that पूरा का पूरा चीज एक साथ बैठ ना जाए, right? So that's how we came out of COVID. 22, as I said, we built the global team. We realized our mistakes around investing in 22. If you look at our Desi portfolios, 22, 23 were horrible, and it took us till the second half of 23 to course correct, and the last couple of years therefore have been much better for our clients. The Desi portfolios have stabilized, the global portfolio has done very well, but a mixture of these two, a diversified portfolio of Marcellus India and Marcellus Global, has given far better returns than the broader stock market in India. And that's my big learning from the last 6-7 years, that you should build highly concentrated portfolios of outstanding stocks, but you should have multiple such concentrated portfolios in different geographies, different risk asset classes, so that each of them offsets the other, and you end up, say, like a Indian cricket team in form. You'll have batsmen who are flamboyant, who are aggressive, counterbalanced with batsmen who are cautious, batsmen who are right-handers, counterbalanced with batsmen who are left-handers. You have all-rounders who can bat a bit, batsmen who can bowl a bit, a wicket keeper who can bat. So you end up diversifying the team so that regardless of what the world throws at you, whether the wicket is spinning or it's a swinging wicket or a flat track, India comes out on top. And that's how I think we need to think about investing. This clarity of thought I didn't have going into COVID. 2 years of sitting at home, reflecting, and then seeing the 22 pounding of our portfolios, थोड़ा सा अकल आया कि कैसे global diversification करना है.
Any specific misses, like probably you were watching a stock or watching a company?
Yeah, I think the big miss is
this,
we haven't been able to get the outsourced electronic manufacturing space, right? So we've watched Dixon's in amazement and admiration for many years now, but we weren't able to get in. It's a good company. I wish I had woken up to it earlier. My reading is that this industry, this outsourced electronic manufacturing industry, is where, say, the outsourced pharma industry was 20-25 years ago, right? काफ़ी बड़ी चीज़ हो गई है, CDMO जिसको बोलते हैं. Divi's Lab, for example, in our portfolio has made us a lot of money. But I wish we had woken up to the attractions of outsourced electronic manufacturing, phones, laptops, computers, washing machines, air conditioners, etc. I wish we'd woken up to it a little earlier and spotted Dixon's का potential a little earlier. But hey, better late than never. अभी भी काम चल रहा है on that space.
Thank you for watching, and thank you, Saurabh, for your masterclass. He made it very simple with his trademark simplicity. Wishing our viewers a happy and a prosperous Diwali. To you as well, Saurabh. Thanks for watching and happy compounding.